Hello everyone, welcome back to Upside Down Data. In this video, I want to bring your attention to a positive development for a change that is emerging on the charts. And this is a development that suggests that the bear market that we've been in for a while could be in its later stages. So if you guys like the content, subscribe to the channel, give the video a like, and follow us on Twitter for updates about our content, including our risk and trend indicators. So what I've got up here is the DXY. This is the US dollar currency index. If you've been following our recent videos, you know that we've been watching the DXY very closely. The DXY is really important for investors to follow because it's inversely correlated with the performance of risk assets. Generally speaking, when the US dollar is increasing in value, risk assets tend to decrease accordingly. And this has the ability to be a predictive indicator, meaning that it has the potential to give you um, leading indications about the direction of the market. And we saw this play out very recently. I mean, just last week, when the DXY reversed back toward the upside after a small pullback, that gave us a couple of days advance notice about the Bitcoin dump and the dump across equities markets as well that followed closely in the wake of the DXY's move back to the upside. So, we've seen this play out over and over again that the DXY has the potential to give you advance notice about the likely direction of the market. And this has been especially the case over the past few weeks and even the past few months. I mean, you can see that the DXY has been in a parabola since May of 2021. So this is a long-standing move that has accelerated in 2022 and now puts the DXY at a 20-year high. The last time it was at this level, currently just below 109, was all the way back in 2002, which as you might know, was a pretty volatile time in the markets. Toward the end of a very bearish period after the dot-com bubble busted. So, we're at this kind of historically elevated level following this parabolic move. And, this explains a lot about the underperformance that we've seen in risk markets, including crypto. This reflects the macro policies that are coming out of the United States Federal Reserve that have been, shaping the performance in risk markets like crypto and equities. So what's going on here on the charts that I want to bring your attention to? What we're seeing here that is interesting and that I mentioned as a positive development is some evidence that this move on the DXY, which again has been playing out for quite some time, is from a technical standpoint potentially becoming a bit exhausted. I mean, it looks like it's been losing some momentum of late. And I want to point that out to you. And we're going to look at a couple of historical examples to see what this could herald for the coming period of time for Bitcoin and the stock market. The evidence that this move on the DXY has been running out of steam is most straightforward and clearest to identify if we look at the RSI. This is the weekly chart for the DXY. And I've pulled up here the relative strength index, which is a momentum indicator, which in combination with analyzing the price can tell you how convincing a movement on price is and how plausible it is that that move could continue versus reversing toward the opposite direction. What we can see very clearly is that the RSI's recent peak came back in May of 2022 when the level on the RSI itself got rejected off the 105 level and pulled back to 101 before continuing on its merry way to the upside. This was the peak on the RSI. It was at about 81. More recently, a little over a month ago, the RSI put in a new high all the way up at 109, this level that it's just about retesting right now. But the RSI was not able to get up to this 81 level again. In fact, it peaked at a pretty substantially lower 76. This is a bearish divergence when we see that the price makes a new high, but the momentum indicator, in this case the RSI, although it could also be another indicator like the MACD, similar logic applies. But here on the RSI, we did not see a new high, which indicates that this new high on the DXY itself was not as well supported by the underlying momentum in the market as the previous highs had been back, a couple of months earlier. So, this first high in May of 2022, um, again in June, and then punching through that 105 level to reach this 109 is where we saw that the momentum was really not supporting the move to the upside. There, we're going to have to wait and see how this resolves before we jump to any final conclusions, because it is still possible that the DXY could get another burst of energy. And if it punches through this level and continues to the upside, breaking this 110 level, that would be a historic move, because it's been more than 20 years since the DXY reached that level. Um, and then we would want to see whether the RSI supported that move. But as of right now, what we're seeing is a continuation of the development of this bearish divergence, meaning that the price is retesting the upper bounds of its recent range, meaning it's at 109 now, and trying to push through there, but clearly struggling at that level, which has served as resistance in the recent past. And the RSI is at this moment hanging out at a level that's even lower than its previous divergent level. So this has the potential to play out into a confirmation of this bearish divergence, which would again reflect the momentum draining from the DXY on a technical level. Now, the technical analysis is not the only relevant one. Obviously, we need to keep in mind that the macro situation, the economic situation, is highly determinative of what we're going to see on the charts here. So this isn't, a golden ticket to predicting what's going to happen next in the market, but it does kind of price in investors' expectations about the macro situation and about monetary policy, and how the Federal Reserve is handling interest rates and all of that kind of stuff. So this is a very efficient indicator in that way too, because it incorporates some of that information. The thing is that information can change, so we're going to continue to monitor that. But as of right now, what this is telling us is that the DXY is potentially running out of steam. So what could this mean for the price of Bitcoin and, by proxy, risk assets in general? One way we can get a handle on that is by looking at recent historical situations that parallel this one, and specifically times in the recent past when the RSI for the DXY reflected a bearish divergence, and we can map that onto the Bitcoin price and see how Bitcoin reacted at that time. This is a small sample size, so this is really just for illustrative purposes, and what it's going to tell us is what's possible. It's not going to give us that much, leverage on what's likely, because we just don't have enough observations. Bitcoin is too young an asset, so it will tell us something about at least what's possible here, even if we don't know exactly the probabilities. But in any case, there are a couple of instances here that are clearly noteworthy. The most, I think, pronounced instance of this in the recent past came back in 2016, specifically in December of 2016. You can see here that the previous high in the DXY had been at this 100 level, a nice round psychological level, which it first visited in March 2015, revisited again later that year in November and December before pulling back, and then it punched up through that level to the upside, reaching this 103 to 104 level at the end of 2016. So this played out over some time. Remember, this is the weekly chart we're looking at, so this incorporates quite a bit of information. And so the DXY reached this level in December of 2016. Yet at the same time, we can see that the RSI put in a pretty massive bearish divergence at that time. The first visits to this 100 level saw the RSI support that move all the way up to an 88 on the RSI. This goes up to 100, so this is a very elevated level. But when it got through, in December of 2016, that 100 level and continued to the upside, the RSI did not support that move. The RSI was substantially lower at that time. It only peaked at 69 before the DXY turned over and reversed to the downside. So November and December of 2016 is clearly a relevant example to look at. So what happens if we go back to the Bitcoin price, take a look at November and December of 2016? Interestingly enough, that places us right at about a $700 Bitcoin. This is as the bull market was kind of picking up steam. And from there, Bitcoin rallied, as we all know, to 20K. So that confirmation of that bearish divergence, which again was a very dramatic bearish divergence, coincided with a major, major rally in the price of Bitcoin. So there is one possibility, one correlation that we see here between the performance at that time of the DXY and Bitcoin. So there's one example. Let's take a look at another example. This one is a little bit more recent, and it's also a little bit less stark. So the divergence that I'm going to show you here is not quite as pronounced as this last one, but it's a divergence nonetheless. And this one is in 2018. So we see that the DXY, after consolidating down here for a while in the early part of the year, rallied up and made its first peak here in August of 2018 at about 97. And then it pulled back a little bit and put in another wave to the upside later in the year in November of 2018. Put in a marginally higher high. As we can see on the RSI, put in a marginally lower high. So that first move went up to 70. The next move was marginally lower at 66. This trend actually continued as the DXY over the next number of months continued to put in slightly higher highs all the way into the COVID crash when it put in a substantially higher high before dumping dramatically to the downside. But as this was all playing out, the RSI continued to lose steam, putting in lower high after lower high. So what if we go look at this confirmation here of this bearish divergence? It was confirmed in 2018 in the sense that it put in a confirmed higher high on the price chart and put in a confirmed lower high on the RSI before turning back over. So again, November of 2018, if we pull back up the Bitcoin chart, November of 2018 brings us, well, what do you know? It brings us right to the very bottom, or the period immediately preceding the very bottom of this bear market. Now, what this means exactly is a little bit hard to tease apart. We could go into the daily level and try to pinpoint the day at which this occurred. I think that that might be kind of overfitting the data, so to speak. It might be reading too much into it if we try to get down to the days and hours at which this was playing out. What I think is more informative is just to note that the bearish divergence on the DXY coincided with this final move down into the depths of the bear market. And from that point, we saw a number of months of consolidation where Bitcoin found its base and then finally gathered its strength to return to the upside and begin its bull market, which lasted into 2021. So these are kind of two versions of a bearish divergence on the RSI for the DXY. In one case, we saw that a rally followed immediately, and it was a really substantial rally for Bitcoin. In another case, we saw that there was still a bit of bear market to play out, but that it was in its final stages, that the capitulation that happened that same month that the DXY put in that bearish divergence was the last move to the downside, the last substantial move. And from that point, a base was built that provided the necessary foundation for the coming bull market. So these are two examples that I think illustrate, very possible, trajectories for risk markets for Bitcoin. I think a safe assumption here would be that, maybe we're not about to put in that late 2016 huge explosive move to the upside immediately. And, it's possible that that could occur, but there is still a lot of macro uncertainty. Inflation is still high, and the Federal Reserve is still tightening and, increasing interest rates. So there are reasons to continue to be cautious. At the same time, even if this 2018 example is more appropriate, we can see that this is, potentially nearing the end. We may have a bit more downside to go, but even if so, I think that we can be looking for a base to be built and expecting that the bear market is entering its later stages, and potentially that we've now played out most of the correction that's going to happen in price. And there still might be some correction that has to happen in time, which means that some sideways movement from whether that's from the current level or from a lower level, depending on how you want to read this past example, whether you want to think of us as right here, getting ready for another dump, or right here, just consolidating. Um, Nobody knows what's going to happen there, but this is the later stages in my best read of the data. So not financial advice, but I think that these historical analogies can be useful, especially when we're looking at something that has such a strong track record as the DXY for helping us to navigate our investments. So anyway, keep watching the DXY. We'll keep on talking about it. It's always really important to incorporate that into your investment strategy, and hope you guys found this useful. Thanks for watching.